Is that better? Okay. Hello? All right, Dan, you tell me when we're good on that. Hello? Testing? Okay, great. Good afternoon. My name is Grace Arnold, and I'm the Commissioner of the Minnesota Department of Commerce, which oversees health insurance for the state. I'm joined today by Erica Helvig Anderson, Senior Director of Public Affairs for MNsure, and Minnesota House Representative Robert Bierman, who's the co-chair of the Health Finance Committee. So I'm really thanking them for joining me today. We're here at a pivotal moment for public awareness as Minnesotans prepare to make their healthcare decisions for 2026 during open enrollment. Right now, many Minnesotans who buy insurance on their own will not have access to additional financial support they've relied on to pay premiums for the past several years. The reconciliation bill pushed through by Republican-led Congress is an attack on the healthcare system that Minnesotans trust and rely on for care. Congress and President Trump had an opportunity to extend these additional tax credits and failed to do so. This is a huge step backward for affordability and access to health insurance for thousands of Minnesotans. It raises out-of-pocket costs for consumers, lowers the overall value of the insurance plans sold on the market, and takes away the ability for thousands of Minnesotans to automatically renew their insurance. When Minnesota health insurers release their final rates for 2026 before October 1st, we'll see the impact of these federal changes clearly. Preliminary rates indicated that the individual and small group rate increases will be the highest they've been since 2017. The average proposed rate increases are 16.2% in the individual market and 12.7% in the small group market. Middle-class Minnesotans are going to get hit the hardest. Those who are going to be most impacted by these increases are in the individual and small group markets are farmers, small business owners, and early retirees. These rising rates will worsen the impact of federal funding cuts, in particular to Medicaid, making healthcare for every Minnesotan, no matter where you buy your coverage, unstable, uncertain, and more expensive. Insurance companies are already pricing in uncertainty and possible coverage losses. They're seeing these policy changes affecting Medicaid and the individual market and making assumptions that those who will remain in the market will be older and sicker, while younger and healthier people will drop out, and that will drive up premiums. With all of this and proposed cuts to Medicaid, we're concerned about the impact and the future stability of the market, along with the cost and affordability of health insurance for Minnesotans. The reality is that when federal subsidies disappear or Medicaid coverage is stripped, those affected are often left to choose between paying for health insurance and other essentials like groceries, childcare, or rent. In Minnesota, we acted quickly to protect families and small businesses by extending a reinsurance program that offset high-cost claims and stabilizes premiums in the individual market. This program has strong bipartisan support, and with good reason. Without it, the Minnesota Premium Security Plan premiums would have been 25% higher than the rate increases I just mentioned, on average. Each year, I've watched leaders work across the aisle to address the rising cost of health insurance for the middle-class Americans who buy on the individual market, and we need Washington to follow our lead. But make no mistake, reinsurance is only part of the solution. It's Minnesota taxpayers stepping in to cover the gap left by federal policies. It's time for Washington to step up and support Minnesota families by restoring the additional premium tax credits that made coverage affordable for thousands of Minnesotans, including farmers, early retirees, and small business owners. Protecting and expanding Medicaid, not slashing it, and removing unnecessary fees and red tape that make it harder to get and keep insurance. Minnesotans shouldn't be stuck with sky-high premiums. They deserve a federal government that prioritizes their health and financial well-being. And with that, and for a little bit more detail about how this will affect people, I'll turn it over to Erica Helvig Anderson from MNsure.
Thank you. Good afternoon. My name is Erica Helvig Anderson, and I am Senior Director of Public Affairs for MNsure, Minnesota's official health insurance marketplace. Each year, MNsure helps hundreds of thousands of Minnesotans apply and enroll in coverage. Having health insurance provides access to preventative care that keeps families healthy and helps protect them from unexpected high medical bills when an accident or illness happens. We serve individuals and families across the state at all income levels and from all backgrounds. We help entrepreneurs and small business owners, farmers, gig workers, and other Minnesotans who don't have access to affordable insurance through an employer. As Congress continues to consider whether to extend the enhanced tax credits beyond 2025, I'm here today to speak for Minnesotans who rely on MNsure for quality, affordable coverage and who will be affected by rising costs next year. Today, more than half of Minnesotans and MNsure enrollees receive federal financial help that lowers their health care costs. This help comes in the form of premium tax credits, which works like an instant discount to reduce the cost of monthly premiums for eligible households. Premium tax credits are a long-standing feature of the Affordable Care Act. On the national level, they've been instrumental in helping millions more lower and middle income households get covered and stay covered. In recent years, federal laws enhanced the tax credits so that more people are eligible and the savings are larger. On average, eligible households in Minnesota are currently saving $538 per month, over $6,400 annually. The enhanced tax credits have supported record enrollments through MNsure and a historically low uninsured rate in our state. But this progress is at risk because enhanced tax credits are scheduled to sunset at the end of this year. That means that unless Congress acts, and soon, MNsure estimates that 62% of our enrollees will see costs go up in 2026. Nearly 90,000 Minnesotans will see an increase on their monthly premium bill, and over 19,000 will lose access to all financial help. On average, consumers who get tax credits today are looking at a cost increase of about $180 per month, or roughly $2,100 annually. That's a 54% increase in the net premiums they pay, just from this one federal policy change. Cost increases will hit enrollees over age 55 and people in greater Minnesota particularly hard. Take a couple in their early 60s in Mankato who have an annual income of $89,000 and are enrolled in a bronze plan. Unless Congress acts, this family will lose all access to financial help next year. Their annual income puts them over the threshold, and they will no longer qualify for tax credits. Their monthly premiums could jump from under $500 per month to nearly $2,000 per month in 2026, more than 4 times what they're paying today, just from this one federal policy change. But even for younger individuals in the metro area, cost hikes closer to the statewide average will create challenges. Consider a family of 3 here in Ramsey County with 2 working parents making together $112,000 per year. Their combined salaries put them over the threshold for financial help, and they will lose access to tax credits in 2026. Their monthly premium will increase by about $170 per month, $2,000 annually. Again, just from this one federal policy change. Many families will face tough choices with their household budgets. The damage doesn't stop there. Additional federal policy changes from the Trump administration will restrict eligibility, reduce benefits, and impose red tape for consumers. Most of those changes take place in the next few years and include ending enrollment eligibility for DACA recipients and restricting tax credits eligibility for some lawfully present immigrants. Reducing the actuarial value of market plans so those plans provide less benefits for consumers. Shortening MNsure's annual open enrollment period so consumers have less time to choose a plan and enroll, and ending automatic re-enrollment and creating a new paperwork burden for Minnesotans seeking tax credits. Minnesotans recognize the importance of having health coverage, but these changes could mean that insurance for many working families will suddenly be out of reach. Some could decide to go without coverage altogether, which could lead to more uncompensated care for our hospitals, an older and sicker risk pool remaining, and higher costs of care for all. We're concerned that these federal policy choices will have negative effects, not just for Minnesotans' personal health, but also wider-reaching consequences across our healthcare system and economy. Thank you.
Good afternoon, everybody. I'm Robert Bierman, State Representative, Apple Valley, and current co-chair of the Health Finance and Policy Committee. The so-called Big Beautiful Bill will have a wide-ranging impact that will harm my constituents. I'm here today to discuss the alarming increases in private health insurance rates, which are currently projected to increase at the fastest rate since 2017, as was noted. Make no mistake, the increasing cost of health insurance is directly connected to H.R. 1 and the failure to extend the advanced premium tax credits. Action taken, as was noted by the Trump administration, will raise out-of-pocket costs, reduce plan value, meaning less coverage for more money. It will also let enhanced tax credits expire, raising net premiums for thousands, and shorten the enrollment period and eliminate auto-renewals for many consumers, making it harder for families to get covered. This means that health insurance will cost more, be harder to obtain, and provide less coverage. Farmers, small business owners, independent contractors, and early retirees will be among the hardest hit. Facing these cost increases and loss of federal subsidies, many people will be forced to go without health insurance, further destabilizing the insurance market and increasing uncompensated care, as was noted, at hospitals and other care settings. I cannot emphasize this point enough. Our hospital system is already experiencing severe headwinds. H.R. 1 makes it worse. More fiscal challenges, including the loss of Medicaid patients and revenue, will lead to service line cuts, make healthcare access less accessible regardless of insurance. Even worse, more clinic and hospital closures could very well follow. Rural areas are especially prone to loss of local medical care and treatment. The Minnesota legislature operated in a very bipartisan fashion to insulate Minnesotans from these rate increases and H.R. 1 by extending the state's reinsurance program. Without this action, projected rate increases would have been 25% higher on average. We've done our part at the state level. Now we need the federal government to do its part and restore the enhanced tax credits and undo some of the damage of H.R. 1. Specifically, we need in Minnesota our congressional delegation to step up for their constituents. I'm talking to the Republican members who voted for this bill, Representatives Emmer, Stauber, Fishback, and Finstead. It is absolutely astounding to me that at a time when policymakers know that the American healthcare system needs an infusion of support, representatives would vote for such a policy process. I'd like to entertain questions, and thank you for being here and getting the overview from where we are today.
Thanks. So HR 1, let's see. It did not, your concern about HR 1 is that it did not extend the enhanced tax credits, right? I think that's what I'm hearing. HR 1, though, is it, I mean, when I look at the filings from the carriers, there's no reference to HR 1 or to expiring tax credits to explain the premium increases, right?
Yeah, sure. So I think the question is getting at, how the tie to HR 1. So there are a number of federal actions that are going into rate increases. At the time that rates were filed, the tax credits were set to expire, and all of the bills that were currently under consideration didn't have anything in there. So they were assuming that they would expire, and assuming current law. That, I think you have a detailed question about, what's in the filings. Often what's in a filing doesn't have the absence of something that will exist, right? And so I think the other thing that, if we sort of take it up a level, there's less subsidy for people, so people are going to drop out of the market because they won't be able to afford it. That'll leave people who are sicker. And it also increases out-of-pocket costs. There's a lot about the way that you continue coverage and who can continue to have subsidy, and all of that bakes into, uncertainty in the market, increased premiums, and overall a sicker risk pool going forward, and that's what they're anticipating.
So part of the rate requests, if it's 17% or 20 or 10 or a chunk of that is an expectation that healthier people, that as there's less subsidy money, some number of healthy people will leave the market, and therefore that has to be accounted for in the pricing. Is that the?
Yeah, so if you're someone who faces one of these really big rate increases, Erica did a great job of articulating what you will have choices that are unpleasant. You will have choices between rent and health insurance. And for people who need health insurance, who are using it, they will often choose that, and they will make sacrifices in other places, which we don't want them to have to do. We'd rather have everyone have coverage. That's a goal. If you say, look, I'm going to risk it, then you're likely to be healthier. And so you'll say, I will get a different kind of coverage or something that's less comprehensive, or I'm just going to do without. And those are people who likely don't think that they're going to use care. And so they're pricing that in and anticipating that over time, sicker people will be the ones who are insured. And that hurts everyone's premiums because that gets baked into not just ours on the individual and small group market, but then more people are going to the hospital without insurance. That gets baked back into yours and mine, which are not covered under the individual or small group market because they are just the overall cost of the system. Any other questions? Dan, do we have any questions online? Do we have any questions online? Okay. Yeah?
You have another? Okay. Here you go.
Thanks.
Yeah.
So I think, I think just today, so I gather there's a stopgap funding bill in Congress, and then apparently it doesn't include anything on the ACA, enhanced premium tax credits. But then some congressional leaders are saying, according to this account, we're still going to get to it. We're still going to get to it. Is there, as you think about it, like open enrollment, I think is November 1st, right? So is that kind of like a drop dead, like if Congress is going to act, they need to do so by November 1st? Is that part of the message, or I'm just curious?
Ideally, they would have acted well before this because they're baked into rates by now, which we approve on November 1st or on October 1st, and are statutorily required to do that, right? I think as the shopping experience goes, and Erica can jump up and talk a little bit about that, if they pass something that's good for people overall, it's bad for the market that it's so unstable.
I can see speak to how Minnesotans will see this if it gets, depending on when it gets passed. So the earlier it's passed, the more transparent we can be when they're shopping and comparing. So right now we're starting to load in our technology so that they can easily see what their tax credit would be. We're really close to missing that window, so then we just have to layer on another form of communication prior to November 1st, explaining how to calculate their APTC on their own. After we pass November 1st, some people may have made choices. They may have shopped and compared and purchased, and then we'd have to explore if that changes after it, how we can adjust if necessary. But that's why November 1st would be another important deadline, but all the way, I believe technically until the end of the year, they could change it. It just will have effect on Minnesotans who've already shopped.
I have one other, and this may be more of a MNsure question. So, but Libby shared with me a couple months ago, y'all had done some scenarios, and you kind of referenced some similar numbers today. So with the pre-enhanced tax credits, 400% of, my inference from the numbers is that like the lack of the enhanced credits would have some impact under 400%, and then a much bigger impact above 400%. Is that right?
Yeah, you heard me say the number 19,000 are impacted. If you want to go over who gets, of that below 400% of FPL, 5,000 of those people would still lose all access just because of how the math works on theirs. But the majority, like 14,500, is above 400% of FPL that are needing tax credits and would lose it. That keeps them to that 8.5% of their income.
So it's about 14,000 above and about 5,000 below.
Yeah.
And then just going back to like, just to give the sense for the magnitude, like in the congressional district one example, for the individual under 400%, it would be $114 a month, I think, extra, which, you know, so times 12, that's what, $1,200. And like a really big for the retired couple above 400%, like $1,500 a month.
Yes, if they keep that same plan. So that's why, I mean, I think we really want to underline MNsure, while I want to stress that, like, we're here to help Minnesotans, so that would be if you stayed on the current plan. Maybe we can find another plan. Maybe your broker can look specifically at your pharmaceutical needs or your provider needs, and you can find a plan that works. But if you're staying on the same plan, that's what, and if that's the plan they like, that would be what they would be seeing in costs. But we're here to help connect you to brokers. We're here to, communicate and explain the reinsurance program that they're still bringing down rates that way, and we're here to help people through the process, but we are seeing those really big increases in especially the older population in greater Minnesota.
Oh, I'm sorry. We have a question over. Can we come back to you? Okay, thank you.
Thank you. My name is Joshua Haberman. A lot of this seems to be assuming that the rates are what they are, and they're that because of assumptions that the law is going to go away and that the people are going to leave are going to be healthy. If something passes late and these people who we're presuming are going to be healthy next year re-enter the market, do the carriers change the rates? Do they make more profits? Does that money get returned to consumers because of how minimum loss ratio? Like, can you walk me through what happens if something is actually done? Because we're not talking about people who are using a lot of care here. We're talking about people who don't think they're going to use any care at all.
I'll turn it over to Commissioner Arnold, but I just say that some people maybe still need care and they'll be going to compensate. So we're not saying only Minnesotans will be affected that do need care as well, but I'll let you talk through the mechanics of the rates.
Yeah, so the rates are filed every year. So if it's passed late, then, they're accounting for uncertainty in the market. If it's passed late, those are the rates that are set for the year. So people will get additional tax credits, and that's great. There are also mechanisms where if plans are making too much money, that money gets returned to consumers in the form of a rebate at the end of the year. And so there is a mechanism on the back end that if it turns out that this is, that the assumptions were inaccurate, people will get money back, assuming that if the plans make too much money, or if they have, if they are not paying enough of their premiums into claims, then Minnesotans get it back. And they have over the past, in my time in this position, there have been years where that's happened. Again, this is it's a tough market. It's, but there are fail-safes if that happens.
Thanks. And this is MNsure probably again, but so thank you. So like your 19,000, you broke that down nicely, 15 and, was it 14 and 5? I think 14.
14.5 and 5.
14, 5 and 5. So I wonder if there's a way to take that 177 a month, because I'm guessing that's for the under 400%, that's going to be a lower number, and I'm thinking for the above 400%, quite a bit larger, but I don't know if you have those numbers.
I don't have the data in front of me. I can check with our data team if we can get to that level of analysis. Also, just want to speak on those scenarios on those handouts, since final rates for those are based on this year's rates and just guessing. So we don't have the next year's rates, so we'll be slightly different, but that's the best we could get for giving you examples of scenarios, which makes it a lot easier than hearing just the percentages.
Yeah. All right, thanks. I think that's it for me.
All right, well, thank you all for being here. Thank you to Representative Bierman and Director Helvig Anderson. We are happy to, if you have follow-ups, please reach out. We're happy to dive into any detailed questions. All right, thank you all.